Hey everyone, I'm Phil Hodgen. Welcome to the Hodgen Law PC International Tax Lunch. It is May 31, 2024. We do this almost every month on the last Friday of the month at noon Pacific time. Listen in online, you're doing that right now, or watch the show later, we'll post it on YouTube. This month's topic is corporate holding structures for foreign investors in U.S. real property. So we're in the middle of a six episode mini series on FIRPTA stuff, Foreign Investment in Real Property Tax Act, and this month is going to be an overview of corporate holding structures. Next month will be trusts. Months after that will be fixing problems in holding structures, and on we go. So let's get started talking about why and how you would choose to have a corporate holding structure if you are a non-resident buying U.S. real property, and how it behaves for U.S. tax purposes if you are the tax professional advising this person. So here's the series, what's coming up, and you can see we're at number 2 right now, corporate structures in depth. Here's the table of contents. Intro, always mandatory. First, we're going to talk about estate and gift tax because estate tax is the primary concern for non-resident investors in my experience. And then we're going to talk about taxation during the ownership phase. What happens if you've got rental income? What happens if you have personal use asset? Namely, you use a corporate structure to hold the condo in Vail that you use to go skiing or, things like that. Then we'll move on to dispositions, capital gain. What happens? How does that gain flow through the corporation or the corporate structure, depending on what you've set up? And then number 5, dissolution liquidation. At some point, you want to pull all the cash out of the corporate structure and put it in the shareholder's pocket, so the shareholder can go walk outside and get a hamburger and a beer. And how do you do that? And finally, I'm going to give you just a couple clues for what to do or what not to do when you have somebody who intends to buy multiple properties in the United States, and how you should handle that for a corporate structure so you don't shoot yourself in the foot. So let's start with the introduction. Here are the common variations that I see. I don't see direct ownership of foreign corporation into U.S. real estate, simply because it's a little bit cumbersome, practically speaking. You've got a foreign corporation holding title to U.S. real estate. If you have rental property, and how do you open a bank account? How do you have a contract with the plumber? Just a bunch of practical problems. It used to be, let's say 10, 15 years ago in LA County, I'd find a lot of escrow companies and title insurance companies were not so hip on how to deal with a sale by a foreign corporation. They're a lot better now, but I used to routinely advise against this just because of the practical brain damage. So one of the ways that you can get around that is just drop a domestic LLC underneath, and for tax purposes, the result is the same, but for dealing with the outside world and vendors, a domestic LLC is a lot more legible. They understand it, and you can go about your day and do your work and collect your rent and pay your expenses a lot easier. Next is a domestic corporation. This is the one in the third from the left. Frankly, these kinds of structures I find when somebody got their tax advice at a cocktail party. Not a good idea, and we'll talk about why in a little bit. Then probably the preferred one is a foreign parent domestic corporation subsidiary. This is good because it protects against estate tax, and it gives you plain vanilla tax compliance for the domestic corporation that owns the U.S. real estate. And finally, on the far right, the two are where you have a C corporation, domestic C corporation, owned by an irrevocable trust. And why on earth would you do that? And it's probably because the guy who got his advice at the cocktail party and formed a domestic corporation woke up to the fact that there's some estate tax risk and wanted to solve that. And having ownership in irrevocable trust, a non-grantor trust, is the way to go to make that protection happen. Fixing problems is 2 sessions from now, and there'll be an hour on that. So stay tuned, as they say. All right, here's just a little summary. The first 2 rows are individuals, where you either have the individual owning the direct corporation, the foreign corporation directly, and the foreign corporation holds title. The main risk for rental real estate is branch profits tax, and we'll talk about what that means in a while. But it's a tax on top of a tax, and why would you pay 2 taxes when you can only pay 1? And then on the personal side, we're talking about constructive income from personal use of a corporate asset. And you know from just being around in the world of tax generally, the IRS thinks this is not a good idea, and they seek to impose constructive income of some kind on the shareholder for personal use of assets. I mean, the big one that they're going after now is private use of corporate jets and stuff like that. We're at a smaller scale, but the concept is the same. Those first 2, the risks are the same. Next, we have the third one down, is where the individual owns a domestic corporation and the domestic corporation owns the real estate. Here we have an estate tax problem. We have a personal holding company tax problem if it's a rental, because you have to compute and decide whether you have a Schedule PH problem, and if so, do you pay the tax, because the personal holding company tax is designed to encourage you to pay a dividend out and have 30% withheld on the dividend to the foreign person. And then again, for the personal risk is the constructive income for personal use and estate tax. The fourth one down is the foreign parent domestic sub. Again, we've got personal holding company tax, and again, we've got constructive income from personal use. And indeed, that's the same thing for foreign grantor trusts and domestic non-grantor trusts. I'm going to ignore the trust solutions, because trusts are, a foreign trust is treated as a non-resident alien individual who never sets foot in the United States, and therefore it's functionally equivalent to, you know, a human, just substituting it in. So let's just ignore that. And we'll talk more about non-grantor trusts as owners of structures next month, and then in the fixing problems the month after that. Now, why do people choose corporate structures? The answer is, first, and for those of us in the real world, it's fairly rare, but it's legit. If the investor is a foreign corporate entity or a foreign pension plan buying U.S. real estate, there's no fear of estate tax, and therefore why even consider using a trust as an estate tax firewall? So a foreign corporation is fine. The foreign corporation can own directly or can create which is a branch operation, or the foreign corporation can spin up a domestic subsidiary. Either way, but that's a legit reason. In my world, I'm dealing with humans mostly. You know, the Mr. Bigs of the world that have cash and they want to deploy it into U.S. real estate because it's safe, and they want to get the money out of their home country, and they want to get money out of the hometown currency and into U.S. dollars. Next one is, why would you choose corporations over trusts if you have an estate tax concern? Well, cost. It's cheap to set up corporations, certainly cheaper than setting up a trust, and certainly cheaper than operating a trust. Corporations are understandable as compared to trusts. Trusts are frankly weird, and it takes a long time just to get comfortable with the concept. What's a trustee? What's a beneficiary? You know, who's the settlor? How do these people interact? What are their rights and obligations? It's just a mess, and especially if you come from a country that does not have common law, meaning its legal system does not touch Great Britain in some way. They say this trust stuff is just weird, do not want. It's expensive and complicated, and I don't understand it, stay away. These last two, control and economic benefits. You know, Mr. Big did not become Mr. Big with a fat wallet by letting go of control of his investments and saying, now somebody else can reap the rewards of capital appreciation if I make a strategically intelligent investment. So Mr. Big and humans in general prefer to retain complete control, which they can as the shareholder of a corporate structure and director and officer and everything like that, rather than giving at least nominal, but as a practical matter, real control to an independent trustee in a trust structure. So they like the control aspect, and they like the economic benefits. We'll see next month when we do the trust one that typically what I will do, it's either the investor will put 100 cents on the dollar of the purchase price into the trust, and the trust will buy the property, or there will be a loan of, and I use 80-20, so 20% is a gift to the trust and 80% is loan, so you have a loan to value ratio of 80% to 20%, well, 80% loan to value ratio. But in any event, who gets the upside? A trust. Whereas if you have a corporation, who gets the upside on a real estate investment? The corporation, and Mr. Big is the sole shareholder of the corporation. Mr. Big is happy. So these are very important. And frankly, it's a hard sell until the assets get to a certain size, and I'm just going to ballpark it and say, let's say 10 million or so and up, where people are willing to think about trusts in a way that, and under that, they just say, and now I'm just going to go with the corporate structure as a practical matter. And a 21% corporate tax rate, who's to blame them? So let's move now to the tax consequences of these various corporate structures, and let's see how they perform. And in general, it's pretty good. So let's deal first with the simple one that we can put a bullet through and say, no, do not want. And this is where the investor owns 100% of the stock of a domestic corporation, and the domestic corporation owns the real estate. The major risk here is estate tax. So what does the non-resident, non-citizen, who is the shareholder of this corporation, dies? A person that dies is called a decedent. The Internal Revenue Code says when you have somebody that has been promoted to decedent status, you have to decide what's in their, quotes, gross estate, close quotes. And this is all the assets they owned when they died. Well, what did they own? They owned shares of stock of a domestic corporation. Corporations generally are treated as being located in the place where they were organized. So if you have a corporation that was formed under the laws of the Bahamas, you have a foreign corporation. If you have a corporation that was incorporated under the laws of Delaware, you have a domestic corporation. And critically, for non-resident, non-citizens, the only things that go in their gross estate are assets that are in the United States, or the jargon is U.S. situs asset. And so if you have someone who owns the shares of a domestic corporation, it doesn't really matter what's in there, inside the corporation as an asset. When that person dies, the value of those shares will be included in the gross estate, and the default rule is the first 60,000, 60, of assets in the gross estate are tax-free and the remainder is taxable. So you can hit the 40% marginal tax rate for estate tax fairly quickly if there's any kind of value in the stock. So this is indeed the risk, and you don't want to have a problem. 2 months from now, we'll talk about how you get out of this problem and eliminate it. But I'm going to show you here one way that you do not do, and this is section 7874, which I think is the very last code section in the whole Internal Revenue Code. There may be one behind it, I'm not sure, but it's way in the back of the bus. Let's start with the idea that you have one of these individuals who got some poor advice and bought the real estate in the name of a domestic C corporation. wakes up, comes to you, you say to that person, you got an estate tax problem. So they say, great. Your first idea, as my first idea would be, is, oh, we're going from this, we can slot in a parent company in a tax-free reorg and no problem. And now the decedent, number two, we form the corporation. And number three, he does a capital contribution of the stock of the domestic corporation to the foreign corporation. So we end up with a parent sub situation. At first thought, you say, hey, no problem. Now, this person, if he or she dies, will have stock of a foreign corporation in the gross estate. Foreign assets are not included in the taxable gross estate of a non-resident, non-citizen decedent. So we've protected this person from estate tax. Except for Section 7874, which says, in simple terms, if a foreign corporation acquires all of the assets of a domestic corporation, or the foreign corporation acquires all of the assets of a domestic partnership, then for U.S. tax purposes, we're going to classify that foreign corporation as a domestic corporation forever. You never lose that taint. It will be a the foreign corporation for U.S. income tax, tax purposes generally, the entire Title 26, will be a domestic corporation. So it's basically, it's a dual citizen, right? If you have a human being that carries a passport from the United States and the United Kingdom, dual citizen, this is the corporate equivalent of it. And the downside is, now you say, okay, this person dies, what happens? Well, they're owning the stock of a domestic corporation as far as the IRS is concerned, and therefore there's a estate tax risk. So you cannot do this and hope to get away from the estate tax exposure. This is just a fail. So how do you fix it? So this is a preview of what happens in a couple months. You accept the risk and you hope that you sell the real estate before you die. And I've got to say, the majority of the people I work with are highly confident that this is going to be the outcome. And you know what? They're right. Relatively few people die while owning the real estate investment, and therefore they pay the capital gain tax, they take their cash, and they go home. No problem. Sometimes it doesn't work, and when it doesn't work, then your descendants will curse the day that you walked the earth, because it'll be a giant estate tax. The next one is you say, well, I've got estate tax risk, but I've got a nice simple operating holding structure for my real estate. I don't want to spend a lot of money on lawyers and accountants. I'm just going to buy life insurance. And you know what? Term life insurance is cheap if the person is young enough and healthy enough. And quite frankly, this is an acceptable way to go. By far the bulk of the time people sell before they die. They don't die while owning the U.S. assets. And life insurance is, in my experience, cheaper than paying me, that's for sure. So why not? The problem with it, and I've just seen this and I'm working through it right now, is someone who bought a property here in California, took this as the choice, bought a 10-year fixed premium term policy. The 10 years is up. He's decided that rather than Plan A was sell within 10 years. Plan B is I'm going to keep this for the long haul. Now he is exposed, and we have to think about how are we going to protect against the estate tax, because he's 10 years older now and life insurance is much more expensive. The next choice is you can give the shares of stock, and we'll talk about gifts in a second. It's a tax-free gift. So think about estate tax not as a tax problem, but it's a mortality problem. So if you pass an asset downstream to a younger person that has a lower mortality risk, you've effectively done some really cheap estate planning. So that's an option. And the final one is you can sell the real estate. So the domestic C corporation sells the real estate to some other structure, typically a non-grantor trust. And if basis is approximately equal to fair market value at the time, you've got a lot of paper and tax returns and hoo-ha, but you don't have capital gain not much of it, and a very low tax, and that just might be worth it to get it into a non-grantor trust structure. So those are the ideas that you'll be looking at if you have someone who has a domestic corporation as a holding structure. You can think of the same things apply equally to direct ownership by human. Well, except the gift problem. Let's look now at estate and gift tax for ownership by a foreign corporation. So you can see in the little pictures, what we have here is humans that own stock of a foreign corporation, and there's no estate tax risk, because as we said, the asset, the shares of stock of a foreign corporation, are located outside the United States, therefore are not included in the gross estate of the non-resident, non-citizen who dies. If the gross estate is zero, then the estate tax must be zero. And that right there is the main selling point of corporate structures for individual investors in U.S. real estate, that one point. Let's talk briefly about gifts. Gifts are interesting. You can do things by gifts that you cannot do with passing things at death. So remember, we said that corporate stock of a domestic corporation are U.S. situs assets, and they're included in the gross estate of a decedent who dies. Well, that's redundant. Anyway, but for a gift, they say, okay, stock is intangible personal property. Gifts of intangible personal property, whether U.S. situs or foreign situs assets, are not taxable gifts. So if you have a structure like this, you can make a gift even, moments before death. You get a completed gift, and if it works, the asset is out of the gross estate, as compared to if you die with it, there will be an estate tax. So whether you have a domestic corporation or a foreign corporation owning the U.S. real estate, the gift of the stock is going to be a tax-free event for gift tax purposes, and off you go, and you don't have to worry about the estate tax anymore. Now, having done that, and we've just covered the estate tax, as I said, is the main selling point for corporate structure, after simplicity, and it's cheap. Let's talk now about ownership phase. So you've bought the property, you've decided on the corporate holding structure, and now you're either going to use the property personally, or you're going to collect rental income. So let's talk first about domestic corporation structures, either direct ownership or a foreign parent domestic sub kind of structure. Income taxation could not be more boring and predictable. You've got a domestic C corporation, you're filing Form 1120, and you know how the Internal Revenue Code works for that. So there's nothing interesting for international tax practitioners here. It's a purely domestic question. There is a Form 5472 filing requirement. If you have a domestic corporation and a domestic LLC owned by a foreign person, but let's leave that off the table. If you have a domestic corporation that has a foreign shareholder that owns 25% or more of the stock of the domestic corporation, then the domestic corporation is what's called a reporting company and has to file Form 5472. One of the triggering elements of the filing requirement is that there are reportable transactions, that's a defined word, between the reporting company, this domestic corporation, and related parties. And so I've had this, and it's very interesting. You have to look at the accounting records for the real estate every year to determine what kind of activity happened, what kind of payments were made or payments received by the reporting company. Were they from reporting related parties? And if they were, then you have a 5472 filing requirement. But if no reportable transactions occurred, you don't have to file Form 5472. And the key thing here is for corporations, generally, if you're looking at capital contributions or you're looking at distributions, i.e., dividends, those are not reportable transactions. Debt transactions will trigger reporting requirement. Anything that looks like a deductible expense or an income item to the reporting company, meaning your domestic corporation, will be a reportable transaction. So it is possible that if you have something like a personal residence that's just used by the individual in a corporate structure, you may have some years where you file Form 5472 and then others you don't. So this is a tricky one, and the penalty is $25,000 for screwing this up. So this is one thing you want to get right. Let's talk about, though, distributions from the domestic subsidiary upstream, because sooner or later there will be a bucket of cash in here if there's a rental activity, and the shareholder would like to get its hand on the cash in the domestic company. And here are the ways you can get money out. A dividend, and generally you don't want to do that because it's at 30% tax rate. This is fixed or determinable annual or periodic income. A tax treaty might reduce the rate, but let's say just 30%. You can accumulate the cash and not take it out and just be patient and let it ride. But at some point, you're going to run up against the personal holding company problem. And so you look at Schedule PH and you see if there's a penalty tax imposed at that point. Frankly, this is something that I've seen, shall we say, honored in the breach, but don't tell the Internal Revenue Service about that. Expenses. This is the classic, this is transfer pricing without using the words. You have some money in the domestic corporation. The domestic corporation has a board of directors. Your individual foreign client is on the board of directors. The client gets a director's fee, does all the director kind of work outside the United States. The domestic subsidiary gets a tax deduction for expenses. The director has no U.S. taxable income because the services were performed outside the United States. Yeah, the IRS will look at these. Yeah, you have to be careful. Don't be a pig, but this will work. Then the final one is loans. You can certainly have loans back and forth. At some point, loans start to look a lot like dividends, don't they? And so you have that risk if there's an audit. The bigger risk, though, practically, is that people just sort of go on a rampage and start lending money out of the domestic corporation upstream to the shareholder or to the ultimate individual, shareholder, ultimate beneficiary owner of the structure. And they never have a plan for unwinding all of this stuff. And I've had a lot of situations where you just have endless number of poorly documented loans, some with zero interest, some not, and you have an accounting headache. And you have a situation where you might have imputed. Well, let's just say I want to stay away from the OID games too. But you run into a lot of problems where you do this and you don't pay interest out on a current basis, and you don't get a deduction, but you've got a loan on the book and you got income. So I would say this can be done if you are a little bit OCD about setting things up and having interest rates at AFR, documenting it, making sure that interest payments are made in the correct direction annually, and things like that. Now let's talk about rental income for foreign corporations. So now you have a foreign corporation owning the real estate asset directly or through a disregarded entity, either way. But I'm going to ignore the disregarded entity problem. This is a lot more complicated than the domestic corporation and all income flowing onto Form 1120. There are two basic rules. The default rule is that rental income from U.S. real estate assets will be taxed by default at 30% of gross rent received. Foreign taxpayers are taxed only on U.S. source income, and of course income derived from the operation of U.S. real estate is U.S. source income. So the default treatment is always going to be 30% of gross rent received. That's kind of not good, is it? because you've got property tax, you've got mortgage interest, maybe you've got all the repairs and maintenance costs, you've got management costs, you got depreciation. Tax on 30% gross can largely wipe you out. So there is another way that foreign taxpayers are taxed on U.S. source income, and that is when you have, and this is the jargony phrase, income that is effectively connected with the conduct of a U.S. trade or business. So this is taxed just like a domestic taxpayer is taxed. So exactly the same way $1 of gross rent would flow onto Form 1120, it'll flow onto an 1120-F. And just in the same way that a domestic corporation would take a allowable deduction on Form 1120, the foreign corporation can take an allowable deduction on Form 1120-F. This is by far better. I mean, you can reduce your income tax rate significantly, if not down to zero. And here's where it shows up on the Form 1120-F. So Section 1 this is all the passive income. And you can see line 3, you just report rents at a gross, column C, 30% tax, and just look at the form. There's no place for deductions. You compute your tax and you enter your total. Compare this to when the foreign corporation is treated as if it's engaged in a U.S. trade or business. So this is the Section 2 of the Form 1120-F, and it looks suspiciously like an 1120, doesn't it? And you put your gross rent, line 6, and then you have all of your place for deductions, and you end up with taxable income at the bottom on line 29. And this is by far the preferable way to go, and you want to force this result if you possibly can. How can you be sure? Well, let's start at my bottom bullet point. You take an example. Somewhere between you buy a giant commercial property and you do it on a triple net rent to Rite Aid. So all you're doing is collecting rent, and the tenant basically covers everything else, no management. That's not a trade or business. So one property, no activity at all. On the other side, you've got a whole fleet of apartment buildings and people running around, and employees and plumbers and managers and lawyers kicking tenants out, and the whole thing. Clearly you have a trade or business there. But somewhere in the middle, what are you? And this is, the default is that the U.S. tax system likes to push you towards having a trade or business. But how do you force that result? Because that's the result you want, and you don't want the government to force you the other way to 30% of gross. And the way that you do that is with a thing called the net election. And so this is an election you bolt onto the back of a tax return, and I'll show you what one looks like. And there's a handout that comes along with a Word file, so you can have a sample that you can build, or you can make your own, enhance the one that I gave you. But it's called the net election because you make this election, and now the foreign investor and the foreign owner of U.S. real estate is taxed on a net income basis. And you can see the citations. 882D is the code section that allows foreign corporations to do this, and 871D is for individuals. And I think this is as close to mandatory as you can get in tax world. Do this. The basic requirements are that you have to have gross income from U.S. real estate. If you don't have income stream, like raw land, you cannot make this election. And the second thing is this gross income cannot be already effectively connected with the conduct of a trade or business. Well, that's fine. Just think of the net election as a protective election. If the government came in with their auditing goggles and they said, we think you're already engaged in a trade or business and therefore should be taxed on a net basis, you say, oh, well, silly me. I guess you got to tax me that way. And if they come in with the goggles and they say, no, you're not engaged in a trade or business, then you pull out your net election and will say, well, actually, here, I'm now classified as if I was. So you can't fail. And I think that's one of the reasons why it always makes sense to make the net election. Once it's done, it applies forever until it's revoked. And it's going to apply to all your real estate. So, you can have income from your property in one year, make that election, and the next year, and the next year, and the next year after that, you do not have any income, but the net election is still in effect with respect to that property. So I'm going to give you a little off the books example of things that maybe possibly I've seen or I've heard about or I've read about in books or I saw on TV, where somebody will buy raw land for the purpose of speculation, just sit on it, maybe subdivide it, maybe just sit and look for appreciation. You can't make a net election because there's no income, but you have carrying costs. The carrying costs aren't deductible because you're not engaged in trade or business. And so you're just eating these costs. Property tax, let's say, maybe liability insurance, so somebody doesn't come on your land and do something stupid and you get blamed for it. So what do you do? Well, I've heard that maybe sometimes people go into a short-term rental agreement with somebody friendly to them, where that person says, "Oh, I would like to park my tractor trailer on a piece of land for 30 days while I'm doing some stuff," or "I need a place to store a few dumpsters for a while." And so they rent the land from you for 60 days. Or they say, I just want a piece of land I can go camping on anytime I feel like it. And they do once or twice, or they go on a picnic. Anyway, the point is, you've engineered a short-term rental of some raw land and you've generated some income. Not a lot, a few $1,000, but enough to qualify for the election. And from then on, future years, you have the ability to take a deduction for the carrying costs of this land, and off you go. You can either capitalize them or it creates a NOL or passive loss or whatever. So this is an idea. Going back to the idea, what should you have as a holding structure? What entity should own the land? If you have a foreign parent domestic subsidiary, you don't have this problem. And carrying costs can be capitalized or deducted, and it works just fine for a domestic taxpayer. This is only a problem for a foreign taxpayer. So this is another reason why you would think about not having a foreign entity, as a foreign corporation, as the direct owner of the rental real estate or any kind of real estate. Here's just a little sample. As I said, accompanying these slides will be a Word file, and you can have this. I've annotated this thing against the code, the regs, and you can see exactly what's required by the regulation and exactly why it's there. So first paragraph, I'm making an election. So you kind of have to blurt out loud so you get the government's attention. I am doing a thing. And then the next thing is you're saying this is effective for the calendar year that I'm filing for a tax return for right now and all subsequent years. And then the regulation says, make a list of all the real estate you own in the United States. And this could be ownership directly, it could be indirectly through a partnership, blah, blah, blah. But anyway, you make this schedule. And I've given you a little table of the minimum required information on the real estate. You can add more if you like, and I've seen plenty of other elections statements that other people have made, and they put the date of acquisition, they do the purchase price and a whole bunch of stuff. Not required by the regs, but you be you, and you do it. So this is all it takes. It's not a hard thing to do, and just as long as you've got some income, I suggest you do it. Here's the regulation just in full, because sooner or later you're going to have a PDF of all these slides on your hard drive on your computer, and it'll just be useful to have the regulation right there so you can double check your statement against what the reg says. So in summary, I'm going to do this. I like having a repeating statement on future year tax returns because I've had a lot of situations where people say, well, I bought this land in 1999. I think I made the net election, but I can never prove it. And so, wow, and how am I going to prove it to the IRS when we take a reporting position? So just so my future self loves me, I'm going to have a repeating statement on the tax return every year saying, hey, we made a net election in 1999 and we've been consistent ever since. Every time a piece of real estate is acquired, do a new updated statement. Branch profits tax. This is the big problem for foreign-owned rental real estate. So here's the problem. If you have a domestic corporation that owns rental real estate, the corporation earns some money, and now there's some cash there, and the cash wants to escape and go land in the shareholder's pocket so the shareholder can go have fun at night. Um, how do you get it out? Well, answer dividend, 30% tax withheld at source. But if you have a foreign corporation that owns the U.S. rental real estate, all that cash is already in a foreign corporation, and the foreign corporation pays a dividend to a foreign individual shareholder. Internal Revenue Service cannot collect 30% on that dividend foreign corporation paid to foreign individual. So there's a hole in the bucket there. So horrors, let's plug the hole, and the hole is plugged with the branch profits tax. And the branch profits tax is really a game in, how shall we put it, advanced earnings and profits calculations. So what you do is, well, let's go on to the next slide, and you can see it on the form. This is the Form 1120F, Section 3, where the branch profits tax is calculated. So you start with taxable income, as you do with all earnings and profits calculations. Number 2, you make adjustments to get effectively connected earnings and profits. And so here you're doing 2 things. The first thing you're doing is you're taking the foreign corporation's total earnings and profits worldwide, and you're just allocating off the earnings and profits that come from the conduct of a U.S. trade or business. So you got that. And then you're also doing the normal E&P adjustments like deducting for corporate tax paid. So in my case, we've got a corporation that all it does is have a single piece of rental real estate in the United States. So the only adjustment we're going to do here is we're going to subtract the tax paid, and we get to effectively connected earnings and profits on line 3. Line 4 is where you say, okay, what's the idea behind effectively earnings and profits? Well, it's a measure of how much the dividend can pay out to its shareholders as a dividend. And if at the end of the year the corporation has a whole bunch of earnings and profits and it plows it back into new assets, buys a new piece of real estate, buys a tractor, who knows, but an asset, there's less money to pay for the dividend, hypothetical dividend to a shareholder, and therefore we need to reduce the calculation for that purpose. And so line 4 is an adjustment upward or downward. They call it U.S. net equity, meaning you've put money, the foreign corporation has put money into foreign assets, and you adjust effectively connected earnings and profits up or down based on that. Well, let's say we've got none of that going on. So line 5 is just the earnings and profits, or there would be up or down adjustments on line 4 if our facts showed it. And this line 5 number is called dividend equivalent amount. It's sort of like a modified version of earnings and profits. And this is a measure of how much money the foreign corporation has in its bank account that theoretically could be paid as a dividend to a shareholder, and that's the amount of earnings and profits that's derived from U.S. activities. You multiply that by 30% and you got your tax on line 6. So that's how it goes. So you can see how they're going to have the 21% corporate tax paid. You can see that on line 2, and then 30% of the after-tax amount on line 6, and that effectively creates a federal tax rate of around 50%, which ain't good. So avoiding the branch profits tax is another reason to have a foreign parent domestic subsidiary, because branch profits tax does not apply to domestic companies, the end. Tax deductions for late filed income tax returns. This is another reason why I don't think you would want to have a foreign company own U.S. real estate directly. If you are late, and late is defined as more than 18 months after the filing deadline for a tax return, you do not get to take any tax deductions. So you have a foreign corporation that doesn't file corporate income tax returns for a while and then wakes up. What's going to happen? Well, the gross rent is reported on Form 1120F. There are no deductions taken, and so the income tax on this rental income is 21% of gross. which is better than the default 30% of gross, but not much better. So I say only no more than 18 months after the filing deadline. There are two rules here, and frankly, it makes my head hurt a little bit, but I've given you the language for both rules, and it depends on whether this is the first year of the tax return or you filed one last year, right? And so you're just catching up, but you're going to have a steady sequence of tax returns filed. And you just have this simple rule, if you're late, but you filed a tax return in the preceding tax year within 18 months of the due date. So make up numbers, your filing deadline is April 15, 2024. You have to file the late Form 1120F by October 15, 2025 in order to be allowed to take tax deductions. If you didn't have a tax return filed in the immediately preceding year, they've got this either or. So you've got the 18 months after the due date, or the date the IRS mails a notice to the corporation saying that you haven't filed a tax return and we're not going to allow you to take tax deductions. The way I read that or thing is, let's say your filing deadline for the Form 1120F is April 15. The IRS is really on the ball. On April 17, they send out this letter, hey, you're late, we don't have an extension request on file, we're denying deductions. The way I read this, it kind of says you're SOOL and you don't get to take tax deductions. That can't be right, but that looks like what it says. As an operating hypothesis, however, in my head, I keep this 18-month rule and I operate on that basis, and we're going to file tax returns accordingly. And I've had this problem where people have had rental property in the United States for several years, and for some ungodly reason, they thought that they were not required to file U.S. income tax returns to report rental income for several years, and so we had to catch up with late tax returns, be taxed on gross at the effective marginal rate, whatever it is, and then within this 18-month timeline, those are the ones we could take tax deductions for. And here's the problem for that. You've got property that has been placed in service, and remember how the depreciation rule says that there's a depreciation deduction for if it's allowed or allowable? Well, that rental property that you didn't file a tax return for several years, depreciation was allowable. So that means your adjusted basis is going down every year for those tax years where you didn't file a tax return and the deduction was denied. And now you're going to sell it, and so you're going to have depreciation recapture on the sale, but you didn't get a deduction in the earlier years, so it gets pretty painful. Constructive income for personal use of corporate assets. So this is a more theoretical than real at this point, though I start to see the drumbeat of the distant drums of the Internal Revenue Service starting to turn their loving care and attention towards this topic. And so it will become a point become something at some point, right? It's like the general contractor who happens to have a beautiful yacht down at Newport, and they go out fishing on the thing, and it's a corporate deduction because I'm entertaining clients, right? And the IRS comes and says, oh, BS. Or the business owns a condo in Vail, and we're entertaining clients, and we're taking corporate tax deductions. No, your personal use. And so through one theory or another, the IRS will impute some income to the shareholder. And if you have a personal use asset and the corporation has no E&P, and you say, okay, there's a deemed dividend, so what, right? The distribution can't be a dividend because there's no E&P along with it. So it's just going to reduce basis in the stock, and who cares? Because when the corporation stock is sold, there will be no gain for reasons that are outside the scope of this, but non-residents do not pay capital gain tax on the sale of corporate stock unless it's a real estate, and what I usually do is first sell the real estate, then liquidate the corporation when 897 doesn't apply. So anyway, I want you to consider this, and I want you to do the quick math. Does it make sense to rent the property that's owned by a corporation to the shareholder that's going to use it, or rent the property to the kid that's going to live in this condo while going to university in the United States? Because the point is, you're going to have to inject capital into the structure anyway to pay HOA fees, property tax, this, that, and the other. Why not have money come in as rental income if it can be completely offset by expenses? And this is just a math game. And if you can do that, I think you should do that. Because then you're going to eliminate a contingent risk that's not a risk today, but it'll become a risk in a few years. And just like, innocent Swiss bank accounts were not a problem for many, many years until suddenly they were, and then they were a very bad problem indeed. So I'm just saying, the world changes. Dispositions. Let's talk about income taxation of real estate sales. It's taxable. It goes on to the Form 1120 for a domestic corporation. This is income tax, or a Form 1120F for the foreign corporation. For the foreign corporation, the gain on sale is treated as effectively connected income, and this is Section 897A that automatically forces that result. So it's going to go on to, line 6 of the Form 1120F, I think. Anyway, as the gross rent, no, it's not, that's the rental income. I don't know which line it goes on, but it's going to go on the income side. So it'll be taxable, and then you're going to take deductions, and the remaining taxable income is going to be taxed at 21% for corporate income tax. Branch profits tax for foreign corporations only. Okay. Remember, we went through this whole exercise of calculating what's the dividend equivalent amount, and you start with taxable income. Well, if you're dropping a bunch of capital gain into a foreign corporation, that's going to create a bunch of taxable income. And through the lines 1 through 6 on that Section 3 of the Form 1120F, you can see that the more taxable income you have, the more you're going to have dividend equivalent amount, and therefore times 30, the more branch profits tax you're going to pay. So what do you do in the year of sale when you have this giant bubble of taxable income? And the answer is, there is a method in the regulations that you can elect into, and I think you should, that in the year of sale you can eliminate branch profits tax and take all your money home, having paid only the corporate income tax at the foreign corporation level. And the idea is that the foreign corporation completely terminates its contact with the United States in the year of sale of the asset. So, as it says here, completely terminates all of its U.S. trade or business, which means it's not doing nothing in the United States. It don't own nothing in the United States. It doesn't reinvest within 3 years. And if you do that, and you file Form 8848 to extend the statute of limitations for the IRS to come after you, because you've got this 3-year tail where you might accidentally shoot yourself in the foot, then you're going to be exempt from the branch profits tax. And what I will do in this situation, just to make sure, because clients will sometimes recycle a handy-dandy little dormant foreign corporation, or domestic for that matter, to some other purpose, and they might shoot themselves in the foot by re-entering the United States and having this foreign corporation engage in business within 3 years, is I dissolve the foreign corporation. I, however, will wait until any tax refund has come from the IRS, because I want the foreign corporation to exist and it owns a bank account so that the refund can be deposited to the bank account, because I've had that problem before too, when I've been too eager to dissolve a corporation. So on Form 1120F, there's a little checkbox, and this is what you're going to do. You're going to check box 11A, and you're going to say, we are completely terminating, and therefore we're exempt from the branch profits tax. And here's just the top of the Form 8848, so you can see what it is. It's pretty boring. I think there are maybe one or two blanks below this, and then a signature line. So this is all you really have to worry about right here. This is the hard part. Finally, let's look at, you've got the sale done, you got a corporation, it's paid its corporate income tax, it's eliminated the risk of branch profits tax. Your corporation, whether it's a domestic corporation or a foreign corporation, is just a giant bucket of money. And you want to take the money home and put it in the individual's pocket. How are we going to do that? Well, what we're going to do is, if you pay out money as a dividend, it's going to be taxable at 30%. So if you have a domestic company and the domestic corporation pays a dividend either to the individual who's the sole shareholder or to the foreign parent corporation that's the sole shareholder, the default tax on that dividend is going to be 30%. You don't want that. So what you're going to do is make a liquidating distribution. And a liquidating distribution is treated as if it's like a sale of the stock. The foreign shareholder is treated as if he, she, or it sold the stock back to the domestic corporation and received in payment for selling the stock back to the issuing corporation, received a distribution of all the corporation's assets, the cash, after-tax cash. So that's a sale of the stock of the domestic C corporation. Now you say, all right, well, my basis in the stock of that domestic C corporation is less than the amount of cash I received in the liquidating distribution. Don't I have capital gain? And the answer is, if you were a U.S. person, you would. You've got basis in the domestic C Corp stock of X and you received 2X of cash, you've got gain of $X and you pay capital gain on that. But for a foreign individual or for a foreign corporation, that capital gain is tax-free. And why is that? There are two categories of income. One of them is passive income, so fixed or determinable, annual or periodic is the jargon, and it's a mouthful to say, and that's taxed at 30% of gross. Is capital gain from the sale of corporate stock into that category of FIDAP, people call it? The answer is no. So the other way that foreign individuals or foreign corporations are taxed is effectively connected with the conduct of a trade or business. Well, if you sell stock that you own, is that sale of an asset in the course of conduct of a trade or business? Not unless you have your stock store, right? No, this is an investment. And so the gain does not fit into effectively connected income. And therefore, since it doesn't fit into either of those, it's tax-free. So just in the same way that a non-resident could buy 100 shares of Google stock, it goes up in value and they sell it and the gain is tax-free. The same way, the gain on the liquidating distribution here for this little mini holding structure that you have is going to be tax-free. So it's a cool deal where you can pull the money out of a corporate structure with only a single layer of tax, whereas for us domestic people, we're going to have a double layer of tax as we pull money out of a C corporation and put it in our pockets. So this liquidating idea has important implications for someone, a non-resident who wants to buy multiple properties. And this problem of buying multiple properties also exists for foreign corporations. So you have a foreign corporation and in the year of sale, it has branch profits tax, but it would like to use the branch termination method that I described a few minutes ago to eliminate the branch profits tax. Well, to do that, you got to get out of the U.S. entirely. You can't own any more U.S. assets. So if a foreign corporation has two pieces of real estate in it, sells one, it can't terminate its branch because it still holds U.S. assets. And so This, the same idea, someone who's going to buy multiple properties, this has implications whether you use a corporate structure that involves domestic corporations or foreign corporations. And so here's the idea for domestic corporations. On the left, you have a corporation that owns two pieces of property. If the domestic corporation sells one of those and does a liquidating distribution of the cash upstream, it's not a liquidating distribution because the corporation isn't liquidating, so it's a dividend. We don't like that. All right, so we'll distribute all of the assets upstream to the foreign corporation shareholder. Well, in that case, the second piece of real estate is treated as if it's sold and the gain recognized at the domestic corporation level and corporate income tax paid, and then the property asset is distributed upstream to the foreign corporation shareholder. So we're forcing a gain recognition on the second property that still remains. By contrast, look on the right-hand side, if we put each property in its own little domestic corporation, you can sell one property, liquidate its corporation, pass the money upstream to the shareholder tax-free, and you're done, right? And you still have a second property that you own in the United States, and no problem. It just sits there until you sell, and then you can liquidate that one and pass the money upstream. And so if you have someone who's just bound and determined to use corporate structures, corporations are cheap. Form a separate corporation for each property that you buy. The main thing that you're going to have to object against this is you say, what if property number one is throwing off just rivers of cash and is highly profitable, and property number two is running at a loss every year? I'd like to net those two things together and pay less tax. Well, my friend, I think you have to think about pass-through entities and specifically a trust structure if you're concerned about netting the profits of one property against the losses of another one. So if that's a big concern, reconsider your first decision on corporate structures. Same idea for a foreign corporation. On the left, if you have a foreign corporation that owns two pieces of property, it's impossible to terminate the branch unless you sell both of those pieces of property in the same year, which means that you might get a suboptimal price for the second one because you're hell-bent to get it sold before year end so you can terminate the branch and get out of the branch profit tax. Whereas on the right-hand side, we've got each entity, one separate entity for one property, and each branch can terminate easy peasy as you go and eliminate the branch profits tax. So there you go. No goodbye slide, but this is just a brief overview of how corporations work as holding structures. They're really not too bad. I think you've got some long-term risk if you want to use corporate structures for real estate. I mean, this is a skate to where the puck is going, not where the puck is now kind of thing. But for rental property, I mean, assuming you can run the numbers and make it work properly, I'd highly recommend thinking about this corporate structure as a way to hold the properties, at least until the government changes the 21% marginal tax rate for corporations. That's all for me. See you next month when we're going to talk about trusts.